Welcome to our webinar this morning. It's still morning here in Alaska, but glad to have you join us. Today we have Peter Myers will be speaking to us about using Alaska Trust for California residents with the ongoing shift in panorama in California and other states that are high tax jurisdictions. There's certainly reasons to look to Alaska for domiciling assets. Alaska Trust Company, Kodiak Trust Company is an independent trust company. Alaska has long been known as a locale of very favorable trust laws and as well as being a no income tax state. There are a number of other very positive benefits of using Alaska for your trust. Kodiak Trust Company itself has been in existence for 5 years now, and we have a lot of years of experience in our staff and working within the U.S. as well as offshore. As an independent, we certainly can provide a lot of very flexible and personalized services for what you need. But we're very happy to have Peter on with us today and welcome you here. Peter is a well-known speaker in the estate planning area as a California attorney and wealth council member, as well as a number of other things. We're very pleased to have him to give us counsel and advice, as well as to be able to speak to our webinars as with today. So I will go ahead without any further ado and turn the time over to him to go ahead and proceed with his presentation. Thank you, Peter.
All right, thank you, Jeff. Good afternoon, everybody, or morning, wherever you are. First of all, we begin with a disclaimer because a lot of times, particularly less sophisticated and educated clients and even professionals think that this is all about a tax dodge. And so I want to be clear that tax evasion is a crime. Anything you do fraudulently is a crime. And so we discuss tax strategies, what you can legally do. We even cite the Revenue and Tax Code, what California allows us to do by statute, as well as the Franchise Tax Board's publications on what it takes to become a non-resident. So we plan within the contours of the law, but as the description of this presentation indicated, we often have to be careful, whether we're in California or another high tax jurisdiction, to think through the client's choice of successor trustee, because in many instances they would, if they're California citist and they're thinking post-mortem after their death, they would want, their local trust company, bank, financial advisor, CPA, that local team or relative, adult child, sibling, to serve as trustee. And often what they don't consider in that determination, particularly if their assets are generating a lot of income, so maybe a real estate portfolio or a very well managed marketable securities portfolio, that in selecting a California trustee after death, they are deliberately subjecting their estates to California income tax, even though the beneficiary may have moved to Texas or Washington State or Florida or Nevada or some other sister state with either no income tax or a lower income tax, including Alaska. So I'm going to introduce some techniques here. Obviously, simply by watching this presentation, you don't become a client. And that's what our disclaimer here says. So let's move on to the next slide. So I begin with the departing resident. So many of us, whether in California or outside of California, are often asked to counsel clients who have said, you know, I'm going to retire in Las Vegas or Scottsdale or Seattle or Texas or Anchorage, even Juneau. And the outmigration is pretty significant. So significant it's affecting real estate prices in all those states. And COVID only accelerated that. I was just on a conference call where I learned that, you know, places like Austin and parts of South Florida, apartment rents, you know, where people thought, okay, cost of living is really low. I can telecommute from these low cost of living places to my company, and realized that, you know, many of these states are not very pro-consumer, and so therefore the landlord can just decide to double the rent from 2,000 to 4,000 a month or 6,000 a month. So we may get some backlash and some of the outmigration in the next few years. Certainly, it's affected the real estate markets in these other states, but we still have clients, baby boomers in particular, looking to retire in lower tax jurisdictions. And then you have the sort of inflammatory incidents that are happening on the far left. This is AOC wearing a gown at a function that she famously painted with a "tax the rich" slogan on the gown. And this kind of not only the fear that engenders in some of our higher income clients, but also sort of the polarization that takes place in the political sphere often is a tactic that causes people to think, you know, I need to flee to safety. So let's move on to the next slide. And we'll go right to what makes a resident a non-resident. So the first question you may get asked is, you know, how do I permanently leave California? And they may even attempt to retain you for this. And I've had a number of California retirees seek to, you know, have me help them leave California. And it really is easier than it sounds, because the Franchise Tax Board has created a publication about what it takes to leave California. There's no safe harbor in leaving. You're presumptively a California resident if you spend time in the state. You may be presumptively a California resident if you spend more than 6 months in the state. But you may be a California resident even if you spend less than 6 months in the state, depending upon these other factors. So it's a facts and circumstances test. And that's what makes it a little bit squishy um, for the clients. And they want some certainty. So they want, you know, a lawyer, a paralegal, or somebody to hold their hand through these factors. But it's really just a matter of you or the CPA or the tax preparer ensuring that they have handled these things that are set forth in the Franchise Tax Board publication. But they include things like the location of your spouse and children. So if your kids are going to public school in California, the likelihood of you saying, oh, well, my condo in Tahoe suffices to make me a Nevada resident goes to about zero, because your children's education is being funded by the state. And I have not seen that case succeed, nor could I imagine it would. I mean, maybe in a rare circumstance it might, but it certainly wouldn't be. That would be what we call a facts poor case. Where is your driver's license? Where are your vehicles registered? Where are your professional licenses? Next slide. Where are you registered to vote? Where do you maintain accounts? Where is the origination point of your financial transactions? Are you using an ATM in San Francisco or Los Angeles or Sacramento? Is your doctor and psychiatrist and cardiologist still at UCSF? Are your lawyers still in San Francisco? So I'm actually speaking to you from Las Vegas right now. I'm speaking to you from my Las Vegas office. So One of the reasons I'm licensed in Nevada and have a Las Vegas office is that I do represent non-California people who don't want a California lawyer. And so I have a Nevada office. Where are your social ties, health club memberships, library cards, real property and investments. So if you leave your residence and don't sell it, a lot of times clients say, well, what should I do? We want to use it for returning for vacation. And why don't you vacation in Carmel and rent out your property in San Jose, because you're going to get enough rental from that property to pay for a couple of really nice trips to Carmel or San Diego, if you'd prefer to do that. So there's some advice like that we can provide as counsel and as lawyers, but it's all set forth in the publication itself. Next slide. Can we establish a taxpayer outside of California? And sometimes for pre-departure planning, we would consider this. We would consider looking at Kodiak Trust. Whether the client is considering moving to Alaska or not, understand that the Alaska trust statutes, and I wish we had an Alaska lawyer on, next time we will, require there be some nexus to Alaska. So, a bank account in Alaska, brokerage account in Alaska, maybe some real property in Alaska, and so forth, will give you sufficient nexus in Alaska to use an Alaska trustee and situs the assets in Alaska. And Alaska being a zero tax state, the client could have children, as I say, in Washington State or Nevada or Texas or some other low or no income tax state with an Alaska trustee. And you don't need to have a Texas trust if your son or daughter is living in Dallas, or grandson or granddaughter. You can have an Alaska trustee and you're not layering another layer of tax on that. But California focuses on where does a trustee reside, where does really a non-contingent beneficiary reside, and where does the grantor reside. Now, in some states, the location of the grantor doesn't matter. Let's take a look at the next slide. And what's interesting here is the grantor domicile is not relevant in California, you'll see. But the place of administration is, and the beneficiary residency is. So looking at the squares in the column A or 1, and then the fourth column over, you'll see that's where California is, the beneficiary residency and the trustee residency. And then other states have different combinations of grantor domicile, and then maybe grantor domicile plus something else, some other connection with the state. And so notably here, I highlighted Alaska, which has no income tax on trusts, and there are the other states that are similarly do not tax income on trusts. Next slide, please. And when do we not even think about it? So if the taxpayer is planning to live here indefinitely, that's fraud. You can't just set up a Nevada trust and say, okay, we're just going to move our assets outside the state, even though they're really for our benefit somehow or another, directly or indirectly. That's not the kind of planning we do. So you may have some less educated or informed clients thinking that, oh yeah, all we have to do is set up a Nevada LLC, have it owned by the Alaska Trust Company, and magically we've avoided all of California capital gain tax on the sale of the assets. No, that's not how it works. Because if the California resident eventually receives a distribution from the trust, there are what are called throwback rules that say we go back and income average you on that capital gain distribution. So let's hypothetically make a $10 million capital gain distribution, not a distribution, $10 million capital gain that's held in the Alaska Trust. And then the client, 5 years later says, okay, distribute it to me here in Los Angeles. And when the trustee does so, the franchise tax board will tax that capital gain distribution retroactively for 5 years. So even though there may be a contingent beneficiary and they may have a contingency, uh, you can't simply get out of the state if your intention is to indefinitely remain in the state and retire here. It also doesn't work if the income being generated by the trust is California source income. And the typical example of that is where the real property is located here. So if they've got a portfolio of apartment buildings in greater Los Angeles or Orange County, that's always going to be California source income. The rental income that generates is going to be taxed back to California, even if the client leaves California. So if that's your scenario, and they really wanted to leave California, they would actually have to exchange out of those California properties to either their destination state or another state with a lower tax footprint. If the beneficiaries work here, or the business site is here, and they're not planning to sell the business, that's not a good fact pattern for us either. Or if they have creditor issues, and creditor issues meaning that they are seeking to set up either a self-settled or other extraterritorial trust for purposes of levering the laws of the forum state that may be more debtor friendly than California, because California is very creditor friendly. If that's the case, California adopted the Uniform Voidable Transfers Act, the UVTA, which says that if you can't avoid creditors, including the Franchise Tax Board, by the way. So if you've sold the asset and you have the liability here in the California trust, and then you think you're going to move that California trust to Nevada and avoid the Franchise Tax Board, you can't do that. The liability belongs to who did the sale. The seller owes the capital gain tax liability. So the UVTA is another barrier to us counseling clients on this point. Next slide, please. So once the decision has been made to leave, what do they do next? Or maybe it's not necessarily the decision to leave, but it's a decision to do an estate plan and leave very substantial assets to a child or a grandchild that has left. And in that instance, how do we ensure the child and the grandchild is truly not a California person? And again, we go back to our checklist from that Franchise Tax Board publication 3100, and create a to-do list and monitor and supervise the effort of that individual beneficiary to change their residence and domicile. Let's skip through a couple of slides because I have covered that. Health club memberships and car registrations and so on. So this is the checklist you might create for a client based on that FTB publication. Next slide. And then if you're going to use Peter Myers or Fox Rothschild, you're going to use my Las Vegas address of the law firm and tax preparer to communicate with us. And then if you do return to California, or your child or grandchild returns to California, you want to ensure they're not creating the impression that they live here by, as soon as they cross the border, they use the ATM and withdraw money and have lunch at Harris Ranch and dinner with the parents in Orange County. And if those receipts add up to 6 months or more of presence in California, they're going to be presumptively a resident. So they need to be conscious of that first of all, be here less than 6 months. But second of all, when you're here less than 6 months, don't make it look like you're here all the time. If your cable bill, you're paying your parents' cable bill, or your child is paying the parents' cable bill in their Orange County house, You probably want that to go to the parents' house for the cable bill, who are California residents. So don't make the mistake of inadvertently creating California Nexus when you don't have any. Next slide, please. So I'm thinking about leaving California. What do we want to know? And this is sort of an audience participation moment, but what I would want to know is first of all, how much of what are the purposes of their leaving California? Is it tax motivated or not? In many instances, it may not be tax motivated. So if they're just receiving a pension or a 401k or a retirement account in the new state, even though they earned that pension while in California, there's an exception that you need to know about in the revenue and tax code. So if it's a qualified pension, then they're going to be taxed in their state of residence, notwithstanding they may have earned that pension while in California or that 401k. But what if their proposed retirement is based on the interest payments on a promissory note from the sale of property while they were a resident of California? That's going to get sourced back to California because the sale took place while they were in California. So I would want to know, why are they leaving California? And to what extent are taxes relevant? And then if taxes are relevant, I want to know, what is their income in retirement look like? Is it going to come from qualified pensions, or is it going to come from the liquidation of a California business or California property of some sort? And then I also want to know, where are there other connections? Are there kids back here? Are there kids already in the state where they intend to target for their move? Sometimes you'll see people heading to Hawaii. Well, you're jumping from the frying pan to the fire, because Hawaii also has a very high income tax and also has a very high property tax and cost of living. So you may not be getting any benefit by a move to Hawaii, but oftentimes we have our wealthier clients want to move to Hawaii, and there's nothing wrong with that. Just don't think we're going to come up with any tax structure that's going to resolve what's going to be a high tax income tax destination state as well. But if it's something like Nevada, Washington, Alaska, Texas, we have some options. So next slide, please. So part two. So we're going to assume now we have a business owner and they want some advice. And so for the business owner, we have the ability to consider how they structure the monetization of their business. And we have to ask some questions. Is it, what do they mean thinking about? To which state are they going to go? If it's New Jersey or New York, you're not going to do any income tax planning, or Hawaii. Who is going to be in control of the wealth? In most instances, our clients want to retain control as long as possible. And then back to my earlier question, is it California source income that's passive, or is it active income are they continuing to participate in hedge funds and money management where they can cite as their operating company in their new residence? That would be relevant because then we can source the income that they're getting to their new business, their new residence. But let's assume that part of their move is that they're going to sell their business. So next slide, please. And I'm going to use Bob as my example, and he's a shareholder in ABC Widgets, and he's planning to move to Arizona. Sell his stock soon. There's no enforceable contract in place. What do we want to think about? We want to think about how to structure the sale. So he says, I'm going to get a $5 million buyout. And the question is, well, how? Are you going to get $5 million for your stock in the C corporation, or a combination of C corporation proceeds of sale and deferred comp? Maybe he's getting paid for a covenant not to compete and goodwill. Maybe some portion of his income is coming from consulting income back to the California Citus business. And we need to know this. And why? Because the next slide tells us why. Because some kinds of, let's go to the next slide. Some kinds of aspects of the consideration for the sale of that business are going to be taxable to California, and other aspects of that business sale will not be taxable to California. And here's a chart that you have in your materials that will tell you, let's say we have a covenant not to compete. Well, if the covenant not to compete is not to compete in Los Angeles, and that covenant is ascribed $1 million, that $1 million is based on your covenant not to compete in Los Angeles. So even though it sounds counterintuitive, that is actually sourced back to California. Jeff Wright has raised his hand. Jeff, is everything okay?
Yeah, no, this is, we have a very similar case to what Bob is doing here. What about directorships where they've sold the business, but they may remain on the board of directors, for example? Is that going to be enough of a nexus?
That is going to depend upon this great case that I have here, Bindley, as to whether that constitutes doing business in California. Does being a director and collecting director's fee from a California corporation trigger California source income? And the answer is probably yes under Bindley. And Bindley is an odd case because it involved it was a very small tax. It was, $750 or something. An Arizona screenwriter who contracted with a California LLC to provide screenplays. And because the contract was with California, the FTB said it's a unitary business and he's doing business in California. And so the directorship may run into a similar problem. But if it's a unitary business in California and they're doing business with that California business, and whether a directorship is doing business or not is a very, very good question. And it's one I'd want to look at. And I think it would depend upon the business itself in California. How much business is going on in California, and are they really doing business in California by serving as a director? But I'd look at the Bindley case for sure, and the statutes that Bindley relies upon. But normally, we thought before Bindley that if you did consulting and received consulting income, that was attributable to your location of consulting. That would be attributable to Arizona in Bob's case, and that he would pay tax in Arizona, which has I think it's a marginal tax rate in the 4 to 6% range. So Bob would pay 4 to 6%, up to 4 to 6% anyway, on income that he received for consulting. Well, then we ran into the Bindley case, and now we have to caution clients in this situation to, consider setting up your business in Arizona, your directorship business in Alaska, and consider you're not just a director for that California company, but you're a director for a number of other companies. So it's not a unitary business where you serve as a board member for companies in California. You serve as a board member in general. You provide consulting to companies all over the country. That's a better fact pattern for us because it doesn't look like a unitary business. It doesn't look like a business at all. It looks like you're performing services for a California business. That'd be a better fight. I'd like to take that one on. That would be a better fight than Bindley was. But Bindley just had the one LLC in the Valley somewhere that he was doing the screenwriting for. There's some very interesting, stock option rules. If the vesting occurred while the California resident was a resident, then California puts its clause into that at the exercise of the stock option as compensation income. California S corporation is going to be taxable to California. Gain on the sale of an intangible. So this is where we can do some pre-departure planning. We can, set up the business in an intangible entity, such as an LLC or corporation, Alaska LLC or corporation, for example. And then the sale of the Alaska stock while the party is residing in Alaska or Nevada or elsewhere, it may not be taxable because it's an intangible asset. It's situs where the asset is located. And since the asset is located in Alaska, or is located where the resident of the stock in the Alaska corporation resides, it may not be taxable to California. Now, there's another complexity to this called tiered income, so that if the Alaska company in turn owns another California company, there may be California source income on the tiered income. But that's like an advance, that's a 400 level class after this one. Income from the tax of royalties, goodwill, and so forth that have a business situs in California are going to be taxable. So you can see here, there are ways of allocating portions of the consideration of a transaction to items that are not taxable, such as maybe the consulting income. We're not sure. Depends on how we set up that consulting business, whether it's a unitary business or not. Maybe the sale of the corporate stock, so long as the Mr. C Corporation Bob has left Arizona before the sale transaction has been consummated, so that the C Corporation stock is sitused in Arizona at that point in time. And we'd still want to know where the company was doing business, because there still could be California source income internal to the C Corporation. But the gain that Bob recognizes on the capital gain on the sale of the C Corp stock is not necessarily going to be tiered income. It's not necessarily going to pass through or come up from the underlying corporate income in that circumstance. Let's take a look at the next slide. Bindley, this gets into Bindley in a little more detail with the FTB regulation. So I'd commend you back to this if you do have that Jeff Wright situation where you have, say a director, somebody. Now, in this instance, note that we could distinguish Jeff's director situation because the taxpayer was a self-employed proprietor of a business that was conducting business in California. And so the Office of Tax Appeals focused on this issue of it was a unitary business. But what if instead Bindley was simply providing consulting services to the LLC, and the contract simply said Bindley could perform them anywhere and should perform them in Arizona? We go back to the underlying contract, and obviously bad facts make bad law. And the contract in Bindley didn't say he has to perform it outside California. It didn't specify the location where the LLC received the benefit of Bindley's services. And so the OTA said, well, it's certainly California. And hence, Bindley cut against us. Bad facts making bad law. Let's go to the next slide. I'm having trouble on my end here with the slides. Here we go. Part 3, now the non-resident. So how do we consider setting this up in advance with an Alaska trustee? So we have our client that's considering leaving, but maybe it's not this year, and maybe it's next year, but they're anticipating a monetization event of an intangible asset, such as stock or a partnership interest in or a membership interest in an LLC, or a partnership interest in a partnership. We would consider in that circumstance first using the California party's exemption, their $12 million roughly exemption, to set up a gift to just complete the gift. You've probably heard about nings and kings and dings. A king is an incomplete gift non-grantor trust. The incomplete gift non-grantor trust is no longer eligible for an IRS PLR, private letter ruling. They ceased issuing those in 2019 or 2020. And so we don't have the ability to rely upon the supremacy clause in the Constitution saying, there's a federal law saying that this is an Alaska trust and it's not subject to tax outside of Alaska. Not that they simply said it was a non-grantor trust situs in Alaska. They didn't opine on whether it would be subject to tax in any particular state. But if you had that at the federal level, you could rely on the preemption doctrine to say, well, the IRS has already ruled on this. It's a non-grantor trust. It's legal under federal law. So they're no longer ruling on incomplete gifts, nor are they ruling on slants, which is where you complete the gift to a spouse. So spousal limited access non-grantor trust, so similar to a slat, but you deliberately set up an adverse party to consent to income that would go to the spouse, and that removes the trust from the impact of 677A1, which says that if the spouse has the right to the income without the consent of an adverse party, it's a grantor trust. And so it's still going to be taxed back to the residence of the grantor. But if the gift is completed, now we may have Kessner to rely on, because now what connection does California have to stock in Alphabet? We'll just let's say our client merged their startup company into Google, and they got Alphabet stock in return in a stock for stock tax-free merger. Now they have stock in Alphabet. Alphabet has California source income. It pays California income tax on its California source income, but shareholders who own Alphabet are all over the world. And what if your shareholder that owns Alphabet is an Alaska trust? And the answer here is that sale, the capital gain, is situs to Alaska. It's situs to Alaska, even if it's a slant, so long as it's a non-grantor trust, and the non-grantor trust is its own taxpayer, it's situs to Alaska. It's a third-party non-grantor trust. Now, when would California be able to tax this? Well, they might. They might. We can't automatically say that we've escaped California income tax, and you have to learn some principles to know when California can tax this. And the first principle is whether it's a grantor or a non-grantor trust. So let's go to the next slide. And a grantor trust is a trust where the grantor is treated as the owner of the assets of the trust. So their social security number is the taxpayer ID number of the trust. So if you could have an Alaska trust that's a grantor trust taxed back to the California resident social security number. There might be reasons for doing that, such as asset protection, dynasty trust planning, but they wouldn't necessarily be an income tax reason to do that. A non-grantor trust, on the other hand, is its own taxpayer. So the trust creator has relinquished certain benefits from and control over the trust so that it's its own taxpayer, and it lives its situs where the custody of the assets is. So for example, in Alaska. You then have to understand the concept of fiduciary accounting income. And fiduciary accounting income is different from taxable income. So fiduciary accounting income may be generated internal to the trust, and it's defined under the governing trust instrument in applicable state law. It has nothing to do with taxable income, because the trust may be subject to taxable income even where it has no fiduciary accounting income. And an example of that would be capital gain, where the trust instrument describes capital gain as a principal distribution. It allocates capital gain to principal, not to income. And in that circumstance, that would be taxable capital gain, even though it's principal for fiduciary accounting purposes. So you need to understand that disparity is why there is complexity in this area. And it's why you can have a capital gain taxed to Alaska, even though it's not automatically income back to the California beneficiary. Next slide, please. So other key concepts to understand are the difference between a simple trust and a complex trust. Now, if you set this up as a non-grantor trust that's a simple trust that has to distribute all income, and the obvious example of this is a Q-tip, any kind of marital deduction trust is going to be a simple trust. That's not going to get you out of California. So if you say mandatory income to my spouse, first of all, it'll be taxed as a grantor trust under 677A1, but even after the grantor's death, you want to put your Q-tip in Alaska, and you think, aha, all of my spouse will be able to avoid income tax on the Q-tip income. The answer is no, she won't, because that's a simple trust and she's a mandatory income recipient. And California says that if you have all mandatory income beneficiaries in California, the trust itself is taxable back to California. And so, it might have a deduction for the income that's distributed to the California beneficiary, but the trust itself is taxed back to California. A complex trust, on the other hand, so for example, a bypass trust that has accumulation provisions would not be a simple trust. And a complex trust would allow for the accumulation of income. And it can, in any given year, a trust can be either a simple or a complex trust. So you could have discretionary accumulation of principal, and the trustee in their discretion doesn't accumulate it or doesn't accumulate the income, and then it's a simple trust in that year. But in the year where the trustee chooses to accumulate that income, for example, they accumulate the capital gain, in that year, it's a complex trust. And now we look to see whether some other factors as to whether that trust is now taxable to California. So we've set up our hypothetical trust in Alaska. It's a non-grantor trust, and it's a complex trust, and let's call it a bypass trust. Okay, so next slide, please. So then we look at the next concept, which is distributable net income. So the bypass trust says discretionary principal and income to wife, surviving spouse, who's in San Francisco, and children, and let's say the children are in Washington State. Okay, we'll have 2 children in Seattle. In this instance, the amount of the distributable net income distributed to wife is going to be taxable on wife's 1040 via a K-1 in California, on her 540, actually, the California state income tax return. The Alaska trust will get a DNI deduction, a distributable net income deduction, of the amount that they distribute to the 3 beneficiaries, if they distribute some to the Washington beneficiaries. You don't simply say, oh, well, they can, if they've distributed any to the Washington beneficiaries, you don't simply offset the California DNI against the California income. There's a very complex formula that your CPA has to apply if there's income going to the daughters in Washington State to calculate how much of that trust's income might be subject to California income tax. But if the income is all accumulated and you have no income distributed to the California beneficiary, so they're a contingent income beneficiary, such as the bypass trust with discretionary principal and income, and the trustee in their discretion chooses not to distribute any income to the California beneficiary, that trust, unless it has California source income or unless it has a California fiduciary, is not going to be taxable to California. So, and I say California source income because that's another way, as I alluded to before, that you still could get California income tax. Next slide, please. So a non-grantor trust can be an individual taxpayer or conduit. And you've seen this in retirement plans. Retirement plans are typically, conduit trusts, because in order to be a qualified, an ordinary, I think Natalie Choate calls them a regular old designated beneficiary, ordinary designated beneficiary, subject to the 10-year rule, it has to be a conduit trust. If they're an eligible qualified designated beneficiary, so a disabled spouse, et cetera, and the other special categories that fit within that Secure Act, that's a little different beast, but it still needs to be a conduit trust. Unless it's the special needs beneficiary, and then it can be an accumulation trust. So, with retirement accounts, you have all these little issues that may factor in. Typically, you're just going to see the conduit trusts in retirement accounts and Q-tips. You're not going to see conduit trusts in bypass trusts, or certainly dynasty trusts are not going to be conduit trusts, because the purpose is to accumulate the principal and to build that over the course of generations. Next slide, please. So this is the accounting definition of distributable net income, and this is the option. It's either taxed here, and I use the graphic to really describe distributable net income, because the visual is a better way of thinking about this. It's either taxed here, and that box in the upper left-hand corner is at the trust level, and then that arrow is at the distribution level. If it's distributed, then it's taxable down there to the kids in the back of the van looking at the map, working their way across the country. So you get a deduction at the trust level, and then they take it into income in their income tax brackets. So the trust may be in a higher bracket than the beneficiaries. In this instance, you would benefit from a little income tax arbitrage by distributing the income out. You have 65 days after the end of the fiscal year to decide this, because often you don't know. You don't have your 1099s by December 31. You have them on January 31. And in that instance, you'll have until about March 5th, depending upon whether it's a leap year or not, to decide whether to distribute the income out to the non-California beneficiary or not, or whether to distribute it back to the California beneficiary, knowing that you're going to get some California income tax on that under this calculation. Let's take a look at the next slide. And this is where this often, where we're most often brought in, is there's a large capital gain intended to be distributed sometime in the future to a non-California beneficiary. So in this instance, the non-grantor trust itself, within its own situs, is going to be liable for the payment of the income tax. So this is your typical king. Well, not really a king, because we've completed the gift. So this would be a KNG, just an Alaska non-grantor trust that's set up where we've deliberately completed the gift. We put $24 million in exclusion outside of the estate in an Alaska non-grantor trust. And then the sale of the asset, the capital gain asset that's not California situs, that has no California trustee and no California non-contingent beneficiary, meaning mandatory income beneficiary. In that circumstance, that gain is going to be taxed solely to the situs of the trustee. So solely to Alaska, meaning a zero state income tax. There'd still be a federal income tax on that because Alaska is still part of the 50 states of the US. So there'd be a 20% capital gain tax plus a 3.8% NIT. So there'd be a 23.8% tax. Let's take a look at the next slide, which goes through the income tax on the ordinary income. So this is ordinary income for a trust, not capital gain income. I just gave you the capital gain stats, which would be up to 23.8%. On ordinary income, beginning in 2020, we have the year 2017, we have these new income tax rates on the ordinary income on trusts at the federal level. And you'll see there's a very low threshold, $13,050 of income, at which it's taxed in the highest federal bracket, 37%. So we have to look at brackets of the income, and we have to look at income distributions out to beneficiaries of ordinary income within that 65-day time frame after the end of the fiscal year. Typically, if it's a fiscal calendar year, that's going to be January, February. We're studying these numbers and we're figuring out whether we should distribute out income before March 5th to beneficiaries who are in a lower bracket than 37% federally, or combined federal and state for that beneficiary. So if that beneficiary is in California, they might be at 37% at a couple $100,000 because their federal is going to be about 27-ish% average income tax. On the margin, it may be 35. And their state is going to be about 6 to 8. And so you have to look at it in those circumstances and look at exactly what is the optimal tax result within those first 2 months of the year. That's why Jeff and I were kind of jokingly say we thought, our practice is super busy until December 31. It doesn't end in December 31 because we've got all these calculations to do on distributable net income before March 5th. Let's take a look at the next slide. California is fairly generous when it comes to trust income tax. So this is another thing to consider. We don't necessarily leave California because of the trust income tax rates, because these are based on the single individual rates in California. So this is from 2021, this tax rate. And you'll see here that these rates are not, for a trust, it would need, $58,000 in ordinary income to hit that 9.3%. that we consider, like that used to be the highest marginal rate in California, and it would need over 300,000 to go to 10.3%. And so when we talk about this 13.3%, we're really talking about the very, very significant monetization events, the large capital gain, because California doesn't give us any break on the capital gain. So we have a $10 million sale, we have a $10 million capital gain, for example, a zero basis asset, that's going to be a 1.33, not quite 1.33 because you get a little bracket run up, but a $1.3 million tax. So that's significant enough for us to think about, maybe we should complete the gift of that $10 million highly appreciated asset to the extraterritorial trust and ensure that it's a non-grantor trust with no California source income and no California non-contingent beneficiaries. So that's where this planning tends to get much more interesting. And assuming the ultimate beneficiaries are not just California residents, where we're simply deferring it, although that may have some value. We can deliberately say, okay, we'll subject this to California tax, but we're going to subject it to California tax when the beneficiaries take the distribution, which may be 10 years from now. 10 years from now, they take the distribution, and then there's that 5-year throwback rule that I alluded to before, where you income average the capital gain over the previous 5 years. So you have a deferral during that 10-year time frame where you're able to accumulate income on the unpaid income tax. Let's take a look at the next slide. This is the capital gain. I probably should put this first of the 3 slides, but this is what I alluded to before, 20%. Plus the NIT, the 3.8%. And then because I often have accountants on these calls, I have to remind everybody, don't forget you also have these recapture assets where you've taken excess depreciation if you've expensed the asset. And so you may have a higher ordinary income, or you may have a higher rate, a 28% rate, or even a 37% rate for some of that excess depreciation and recapture. Again, way beyond that's a 400 level course, way beyond the subject of our discussion today. But know that if you've got things like, equipment that's been expensed, cost segregation in an apartment building where you've expensed the refrigerators or put them on a 5-year depreciation schedule or a 10-year depreciation schedule for the roof or something like that, you're going to have some different results than what we're describing here. You're going to have a little higher tax on the sale that's ascribed to those assets than on the actual, the building, the structure assets, and the land. Let's take a look at the next slide. So how do we create a non-California taxpayer? Well, we have to situs it outside California. So we look at Alaska, where most advisors are looking at those 4 or 5 states that does not tax income earned by trust. And we establish a situs in that state, usually a trust company or a resident of that state. Ideally, and in the case of Alaska, they're holding bank accounts within that state. You need to create a situs there. They're intangible personal property, and they're deemed situs where the account holder or the shareholder resides. So they're deemed situs in Alaska by that Alaska trustee. Let's take a look at the next slide. Now, California will still turn around, as I've alluded to throughout this presentation, they can still turn around and subject that Alaska trust to California income tax if any one of these 3 factors are present. 1 or more fiduciaries are California residents. So you think, oh, well, mom is going to be a co-trustee of her Q-tip or of the bypass with the Alaska Trust Company. In that circumstance, you're still going to have some California income tax because 1/2 of the fiduciaries are in California. And so 1/2 of the income is going to be ascribed to California income. 1 or more non-contingent, meaning mandatory income beneficiaries are California residents. The trust is going to be ascribed to California income, or the trust itself has California source income. The apartment buildings are generating rental from, the LA basin, and that's going to be California source income. So they're still going to have potentially some tax. Again, this isn't a tax fraud. This isn't an evasion issue. It's a deferral, or, do you really have to allow California to put its claws on your trust if California really doesn't have a connection to that income? What's notable is the settler's residence is irrelevant to this determination. Let's take a look at the next slide. So these non-resident trusts, when they accumulate income, can defer California income tax. And I alluded to the throwback rules when the long-term capital gain is distributed back out. So you don't entirely escape California income tax if the beneficiaries remain in California, but you do have this income averaging and this deferral under the revenue and tax code in California. And no matter what, the source income is always subject to California income tax. What about C Corp stock in a California situs asset? Well, it depends. Why is that corporation a California corporation? And this is where we get into a little more advanced planning, and we get into a little more of the tiered income issues and the unitary business issues and the California source income issues. But in general, simply because I live in Nevada and I own stock in a California C corporation does not make my sale of my California C corporation stock California source income per se. There may be some California source income. There may not be some California source income, but that's another factor we have to consider is like, why did you form the corporation in California? Is there a way to avoid having a California corporation? Why is any corporation formed in California? Sometimes it doesn't matter, right? I formed California corporations, California LLCs, California partnerships, because it doesn't matter. We're not doing anything fancy with the taxes. They're doing all business in California. There's no reason to set yourself up in another state. And so that's fine. You just set yourself up as a California partnership. But we have to look at that too. We have to look at where is the corporation registered. Next slide. So contingent, multiple trustees are beneficiaries. So this is the proportional interest rule. I alluded to this before. So if 1/3 of the trustees are in California, then 1/3 of the income is taxable as California trust income. So it's the proportion of resident and non-resident fiduciaries, and it's the proportion of resident and non-resident mandatory, in other words, non-contingent beneficiaries. And this is where the calculation gets complex, is if you have, say, 2 income beneficiaries who are in California and 2 out of 3 income beneficiaries who are California and 1 out of 3 fiduciaries who are California, you get into a fairly complex calculation. I would commend Spidell has a pretty good example of how to conduct that calculation. They're a good secondary source to look at for this, SPIDELL. Next slide, please. But when there are contingent beneficiaries, in other words, you've drafted the bypass trust so that income and principal are subject to the trustee's discretion, they are contingent beneficiaries. That's what makes them contingent beneficiaries. And so long as the trustee who is exercising that discretion is not in California, then California doesn't have any reason to tax that, and there's no connection to California sufficient for the revenue and tax code to apply. No matter what, understand that any distribution made to a California beneficiary of income is going to be taxable to that beneficiary via a K-1, but it's going to be taxable on their 1040. Now, what if they're in a later year, they move to a non-tax jurisdiction and then the distribution to the beneficiary occurs? Then in general, we say this 546-day safe harbor rule applies. So the beneficiary has left California for 18 months. And in that, after that time frame, and that's a safe harbor for an employment contract outside California, but in general, that's the tax practitioners believe that to be the safe harbor, as it were. So they've moved to Washington State, Arizona, Florida, Texas, and they've been there for 18 months. And then the Alaska trustee makes a distribution of the capital gain to the California or to the Texas resident. At that point, California will not be able to exercise its 5-year throwback. Next slide, please. That is the contingent beneficiaries we discussed. Next slide, please. Looks like I had that slided twice. When would we want to consider a spousal limited access trust for this purpose? And in general, it's where that client is not ultra wealthy. They're in that $20 million range. They're in that $20 to $30 million range, or $15 to $20 million range. And they're considering maybe, I don't mind making allowing my spouse to retire off this, who's 10 years younger or what have you. But my spouse may not live in California indefinitely, and it doesn't make sense for me to set this up so that it's always going to be taxed in California. So then in that instance, you may be considering a slant whereby you do a spousal limited access trust and deliberately complete the gift. So you file as the 709 gift tax return, even though it's to a spouse. So you're not saying, I'm relying on the marital deduction. You're saying, forget about the marital deduction. I'm electing out of the marital deduction. I'm using my exclusion, even though my spouse is a beneficiary, because she's a contingent beneficiary. The distribution of income to her is subject to the consent of an adverse party. That makes it a non-grantor trust, and it makes it contingent. And so in this circumstance, we sometimes find that this is a viable technique to use where you have that potentially departing resident who's got the monetization event while in California, but they're considering not using the money until they've left California. In that circumstance, we're looking at a slant as a possible solution. Let's take a look at the next slide. I just put this in to let you know there are developments always on the horizon. Legislative Proposal C and AB 310. Thus far, these two proposals have failed, but it all has stemmed from this movement that a lot of my clients find fearful, and this movement that the rich, the air quote rich, have gotten away with low income taxes. Not that 13.3% is low, but perhaps relative to maybe France, it's low. There aren't very many places where the combined federal and state exceeds 50% in the world, but they do in California. And there's a perception that the air quote rich are somehow getting away with something because half of their income is going to tax, and I guess it should be more than half the income. Obviously, we have disparities in wealth, disparities in income. The solution is not necessarily a redistribution plan through the tax system, but there are some people who believe that. And because of that, we have a lot of clients who are really interested in this kind of planning. And so far, the efforts of the legislature have failed to bring about any wealth tax or any this legislative proposal C, any California source income tax on the ning or the king or the ding. Thank you for joining us. If you have any questions, I'll check the chat box. I don't see any raised hands or any questions. So that's all I have for today. Thank you for attending. If any of you have questions of me, you've got my phone number. You can talk to Jeff or Patricia, and they can get you to connect to me. My phone number, I think, is in the beginning of the slideshow on one of the first few slides. So thank you all.
Thanks a lot, Peter. I would definitely say that was at least a 400 level class. It was a lot of pretty in-depth, but very good food for thought, and why you need to always be working with a CPA that really knows this wealth planning stuff.
Well, it's hard to do these presentations with these absolutes, which is why I have to footnote so much of what I'm saying. Well, it depends. In many instances, this can work, and so my apologies for adding that complexity, but I want to ensure that people aren't misled into thinking, oh, you just set up an Alaska trust and it's all over. There's a lot to it.
Right. Are there any other questions from anybody else in the group? If not, we will go ahead and close. We appreciate your time, Peter, as always, and your knowledge, and welcome anybody to get back in touch with us if they want to get in touch with Peter or receive notes from this webinar. Thank you.